Welcome back to another episode of Broker's Blueprint. I'm Martino Picariello, your host, with my new co-host, Chris Tereo.
Let's go. What's up, guys? Chris Tereo.
Dude, we had
so good that guest appearance. They brought me back full time. Let's go.
I was just about to say, it was like the most natural podcast I think I've ever shot.
Yeah.
And I was like, wait, this guy, he's got something. He's got something. He's got the secret sauce, and it's not something you can duplicate.
Yeah.
So welcome, Chris.
Thank you.
I mean, leader of the #1 lending company right now in Philadelphia, private credit, right?
Yep.
So it's an honor to have you. Your knowledge, your access, your relationship capital, which I always say is the most valuable thing that any of us have, is our relationships.
Thank you. I agree.
Chris is going to be able to bring some really cool people onto the show.
Yep.
Chris, welcome. Appreciate you.
And Nick is still here.
Yes.
Just so everybody knows.
Yes.
You can call me Nick if that makes everybody feel better.
I might mess up. Yeah. But no, like, I mean, really just grateful you're on. But want to jump into like you guys already read the caption probably. Taylor and I took a lot of time making it.
Yeah.
I mean, what's going on with tariffs? How does it affect us? And I'm really excited to just jump right into it.
Yeah, same here. It's been a crazy, crazy week for sure. So I'll tackle it from like the investor and lending lens, if you will. So, last week with all the tariffs being released, the new plan. So you saw the Treasury yield, 10-year Treasury yield, which is what mortgage rates typically follow. You saw that dip below 4 for the first time since September. So
awesome.
what? Yeah,
for at least most investors, that's good to see.
Yeah, and I guess I'll get into like the why behind that. So when there's volatility in the market, investors will pull their money out of stocks and go into government bonds, right? So yields go down, prices go up. Bond prices go up. They have an inverse relationship.
And these bonds, what do they offer these investors? Why are they taking their money from a stock market that's volatile and putting it into a bond?
More stable returns.
Okay.
Right?
Makes sense.
Yep. So, but there's a fine line. So you of the market volatility. So in a weird way, market volatility is good for our industry and like mortgage rates, right? Like rates went down. But what you're seeing this week is investors and like the hedge funds, they're kind of losing confidence in the economy, or like in a sense of like, is future inflation going to prevent the Fed from cutting rates or even keeping rates the same? Now they're like, oh man, is the Fed going to increase rates? So that's why now you're seeing people pull out of bonds and you're seeing yields go back up. So there's like, if you look from like mid last week to this week, it was like rates down, yay, rates back up, boo, rates down. Yeah, it was like a straight up roller coaster.
Yeah. So people, if I'm hearing you right, just aren't investing really in or pulling their money out of both, like bonds and the stocks.
Yeah. I mean, there was, and look, I'm also not an economist, but like I know there's also, because there were such massive losses, I'm sure there's like margin calls too. So you also are just like pulling money out of bonds, like you're cashing that in to cover margin calls too.
Yeah, the interesting thing about the stock market is you can win on either side of the coin.
Yeah,
things go up, you had a call, amazing, good job.
Yeah,
you put in a put option, right, for things to go down. I'm sure all you stock junkies know exactly what we're talking about here.
Yep,
you can still make money. I've talked to some people that are really succeeding in this market because they've been waiting for it, and I've talked to some people who have really been kind of putting chips on top of this inflationary. Kind of like, I don't even know how to explain it because no one's understood the growth that we've seen.
Yeah.
It doesn't have any legs to stand on, it feels like, and people have been waiting for a bubble to burst, if you will.
Yeah.
But still, I think people were like, dude, we're riding the wave. Let's keep riding the wave. And then you have these people who are like, every wave has to come down to the shore and kind of refresh. And I think that's what we're seeing right now. So these tariffs are kind of this wave crashing, or at least causing, like, it's something that Vince said, our podcast producer. He was like, you have all of these little kind of like matches, right? And then there's just one thing to spark everything, and it just creates a chain reaction. And these tariffs, I think, were that.
Yeah, you wonder, like, Scott Bessent, the Treasury Secretary, and Trump, like, they're obviously like, no, like, everybody stay strong. Like, this, we're going to feel a little pain. How much of this was by design to, like, lower yields, lower mortgage rates? But the problem is you need to have like that volatility, like controlled volatility, but then still have confidence in your government.
And confidence just means certainty.
Yeah,
right?
Certainty, or like
some kind of predictability of what's going to happen next.
Right. And like some general sentiment around positive sentiment around the economy as a whole. It's like, okay, market's volatile, but we feel decent about, the end result. Mm-hmm. And like what you're seeing now is like you have a bunch of the billionaires coming out speaking against Trump, like this is a terrible decision. So you're losing that government confidence. Mm-hmm. And that's where that like tightrope, the plan starts to fall apart.
Yeah. And what was the end goal in your mind? I think we all know it, but like there's probably a few different end goals that were trying to be accomplished by increasing tariffs. In some cases, 100% on countries, China.
Yeah. Lower the foreign deficit, obviously. Yeah. Lower mortgage rates. Trump's a real estate guy. Let's not forget that.
Can't forget Trump's a real estate guy.
Right?
Made his fortune in real estate.
Refi a bunch of government debt, right? I mean, look, I don't know the entire economic plan, but those are like top of mind, which I think would be right.
As a broker, I'm thinking industrial storage space, manufacturing spaces, right? Yeah. I think bringing them back as well. So let's make more cars here. We can't obviously bring everything back that we're exporting, right? Like bananas. They're probably not going to be, the best here in the States. Yeah. We get those, I think, from Cambodia, Vietnam, right?
I love bananas, dude. They're great. Potassium.
A little bit of yogurt.
Yeah.
Come on. I'm not a breakfast guy, but I'll do a banana. So you got these things that we can't obviously create here that we do need exported, but we're still going to do these tariffs either way too. I think to your point, reset some debt, right? Just to bring that all in. I think it's like reset our debt, refinance our debt if possible. Yeah. And like you said, Trump's a real estate guy, kind of make things more affordable once again from an investor perspective.
Sure.
So that's really where I want to kind of take the conversation next.
Yeah.
What does this mean for buyers and sellers? People that listen to our podcast are investing, shaking and moving, trading.
Yeah.
On the buy side, it's pretty clear to me that we're going to be in a buyer's market. A lot of people in times like these want to take their money and run, if you will, kind of cash out of the crazy appreciation we've seen in the last 6-7 years. Just like, hey, how much more can it really go up in it depends on what position you're in, right? In my lifetime, right? So if you're in your 50s and 60s, you've owned a real estate for 30 years, typically. Is it really going to continue to rise, you think? I mean, I don't see it.
But what type of buyers are going to be buying? Because you still have the people that own their real estate in a 2.75 mortgage.
Right.
I'm in that pool with my wife, and I can tell you right now, we're going to rent that thing. We're not selling it.
Right.
Like if we're in a position to rent it, buy something else, great. If you're not in that position and you need to sell your property to go buy something, no one's trading in 2.75 for a 6.5 or a 7.
No one. So to your point, I totally agree. It doesn't make any sense to do that. And to your point, I think rents are going to continue to increase as well. So rents, I don't see them going anywhere because when cost of construction goes up due to these tariffs, which is something that we'll dive into for the developers that listen to the show.
Yeah.
The developers, the flippers, even the light cosmetic rehabbers, right? When all of that kind of gets tightened, obviously supply is going to be limited because not a lot of people are building what we've seen in the last 5 years, let's just say. Mm-hmm. So rents now, because supply isn't increasing, but demand is still there. People still need to live. I think your rents are going to go up. On top of that, Philadelphia, just to be more hyper local, because we're a Philadelphia-based show, no one can afford, in my opinion, I don't think many people are going to be able to afford to live in New York City anymore, Washington, D.C., or Boston anymore. And people are going to look to more affordable cities like Philadelphia, maybe Chicago, maybe Memphis, right? Maybe, I don't even really know if Nashville's affordable anymore, right? But it's like, you're going to start going to where the heat is, right? And you're going to start going to where you can survive at a better rate.
Yep.
So I think if you're in Philadelphia, you have a property at a below 4% interest rate, even 4.5%, 5%. You got to try your very best to hold it and rent it out to create long-term net worth and longevity for your family, your family's family, all that stuff. And to answer the question of who's going to be buying, it's first-time home buyers.
That's right.
Finally is now your time to shine. You've been probably waiting for 5 years for this crash to happen, right? Yeah. All my friends are 28, 29. You've been waiting forever for this to happen. Now's your time. Go. Make aggressive offers. Have sellers assist. Try to come to the table with as little as possible. Talk to lenders that are, really offering incredible grants offering great, buy down options, whatever it may be.
Yep.
Because you actually could probably get a great deal right now.
Yep.
And if you can get out of renting, because to my point earlier, your rents are going to be going up over the next, I don't know, say 4 to 5 years, because construction is a lag kind of thing, right?
Yep.
If we're not going to see any units come to the market or any permits being pulled now, it'll probably be 4 years until we see like big multi-units really start to populate like they once were.
Yep.
So that's the overall consensus on the buy side. I think you're a renter, try to get out of renting right now, because rents are going to increase. If you're a homeowner who's got something below 5%, hold on to it, rent it out, try to make your next investment now in this buyer's market, and keep accumulating assets.
Yep.
Yeah. What do you think? Is there any risk in that? I mean, there's always risk, but what do you think the big risk would be in like you renting out your place, you doing it, like just from your own perspective, how does that look for you?
Yeah, man, I would say tackling it from like the investor side. So if you look at, again, like we're generalizing the entire market, but like if you look at the majority of like these new home buyers, then like maybe there's an argument to be made for, if you currently, your business as a real estate investor is like, fix and flip for luxury stuff and some middle market, maybe focus a little more on the middle market stuff. Like maybe the luxury is not going to be moving as much.
Totally agree.
Because your buyers, like the people that would be buying the luxury, more stabilized or families that have, like late 30s, early 40s, buying that house, they're not leaving that rate, which we were just discussing. And you got our peers, right? Or like low 30s, mid 30s, they might be buying their first home because they've been renting forever.
Yep.
And
average home buyer, first time home buyer is 34.
There you go.
Yeah.
Yep. So they might not be buying that luxury home to start. So
totally agreed.
Yeah.
And typically, especially in markets like New York, probably more so markets like New York and Boston, you have international buyers.
Yeah.
That are buying these, multi-million, tens of millions of dollars of property. That's Sirhan's kind of selling, these Frederick Eklunds of the world.
Yeah.
I think their market is going to be really hit, kind of like it was in 2008. Whereas the middle market people, like the first-time buyers, the people that are maybe getting a second investment property or a second asset, they're not trying to swing for the fences right now. Like to your point.
Yeah.
And you actually brought something up just to switch over to like maybe your renovators, your flippers, and you work with tons of them. What kind of advice would you give them right now in this kind of market? Yeah,
I'd say like stay in your lane. For sure. Don't try to go do that big fancy luxury new construction if you haven't done that before. Like there also, by the way, there's plenty of people that are actively doing that and crushing it and doing it very well.
Yeah, absolutely.
Plus when you get into that like super luxury space, no one really cares about mortgages. Those buyers don't really care.
They're cash and refining pretty much 90% of the time.
Yeah, it's almost like the light luxury market, which is where those buyers are still using a mortgage.
Yep.
Like that's where I don't love that asset as much. But anyway, sorry, I got sidetracked. It's going
to happen on the show. Welcome to the show.
Yeah, I know.
Welcome being a host finally.
Question?
Yeah, exactly. Come on, Nick.
Yeah. Wait, no, actually, what was your question? I forgot.
Basically, like if you're a flipper, like that middle of the range, like you said, stay in your lane. I think that's huge. Yeah, don't be taking huge risks right now.
Stay in your lane. Don't try to go do that big fancy new construction project when you haven't done that. If you've primarily executed well on the light to moderate fix and flip rehab game, stay in your lane because construction costs are going up with the tariffs. Like we're already seeing it. It's not just lumber and concrete. It's like the finish items. It's like stereos, and it's like the bells and whistles that you're putting in a house. Like that's this. It's like death by 1,000 cuts. I think we talked about that last time, but I just, a builder said that to me, and I thought it was such a good line. It's like you got to make sure you stay in your lane on these projects. And like maybe if you're underwriting a deal and you know that you could do a full gut rehab and get a higher ARV after repair value.
Thank you for explaiing that.
Yeah, of course. Yeah,
need that.
ARV.
This is like his second language.
That's right.
Yeah. He's like,
I speak in 3-letter.
Gracias. Thank you.
Yeah. So, or you could trade that in and say, you know what, my numbers still work doing a light rehab, like maybe just a 50K rehab instead of a full gut 200K rehab. Yes, you're sacrificing this larger exit value, but it's a safer sort. Like, you still make money. Your cash on cash return could still be profitable, like the same margin, right?
Right.
But you're protecting your downside risk with increased costs right now in this market.
And that's a great point. Like, just protecting your downside risk.
Yeah.
It's going to be the number one thing. And what did Andrew Yeager say with Axe Builders?
It's so.
Do
you remember?
I would listen to the episode last night. Andrew, this is for you. But get your clients, get yourself, if you're an investor, get yourself comfortable with the worst case scenario and excited for the best case scenario. Right? Boom.
That's great.
We got to get him back out.
Raising money. That's for the investors.
Dude, just get comfortable with the worst case scenario. Truly. Because if there's like a worst case scenario, like, I mean, you're going for this high ARV.
Yep.
You know, I'm in Point Breeze trying to get 650. And I actually am right now. But we just went under contract. Shout out to my brother, Angelo, Picariello Group, our new development company. We were able to kind of get this one done in time. You know, we actually got the contract signed before 2-3 weeks ago, right? Getting sidetracked. But if you're going for these high price points in these mid markets, man, you know, really, really make sure you're comfortable with that. We were comfortable with a 580 number. That was kind of like something that we were like, all right, we still make a good exit here. We get, you know, one of our first projects under our belt. You know, and everyone's kind of happy at the end of the day. Like 580 in Point Breeze is still a great price for what we had.
Also, like, you protected your downside risk. You knew that it was going to work at a 580.
Yeah.
You also, if you have investors on that deal, you tell them 580 and then you do 650, you come out a hero.
Absolutely.
Set the right expectations.
Oh, I did.
Under promise.
Under promise, over deliver.
Yeah.
Like that, honestly, all those things just happened, right? So the guy who invested with us, he's like, "What's next, boys?"
Yeah.
You know, so it's like, it's a good feeling, and now we can go to you, go to like other investors and say, "Hey guys, this is our track record."
Yeah,
you know, that's so invaluable.
Question: did that person fund the whole project?
No, they just put up half of. They actually helped us purchase the land.
Okay.
We put the land up as collateral. He was a family member, so full disclosure.
Yeah.
It was like,
which is the best place to source investors, friends and family.
They're all sitting on equity. Like,
yeah,
they all want to take these chances, and they all love you. So, like, you know, like that's a good combination of three things. Take advantage of it. So anyway, we're just, to your point, mitigating our downside risk, getting the right outside people involved. And just not trying to get like overzealous or, there's a lot of words that come to mind that aren't the greatest to say on this podcast. Just calm down, you know, like just keep it. Yeah,
don't get over your skis.
Exactly.
Yeah.
Keep it simple.
Yeah.
That's what we should be doing in these markets as a person who's either savvy, which I'm excited to go into that.
Yeah.
Either you're a savvy investor or you're just a first time buyer. You're a first time home buyer. Be aggressive on your offers. Push for stuff that you want, because right now sellers are going to be receptive. And if you're a seller right now, I'm telling you, get to the market as quick as you can.
Yeah.
The more time that kind of transpires and the more we can see the results of this, the more buyers are going to be certain that the trend is down. Whereas right now, if you have the right agent, the right marketing, the right price, you can get out of the house quickly with most of your cash intact, with maybe an as-is sale or multiple offers, and you can waive inspections on stuff.
Yep.
And it's hyper-local. Burbs are a little different than what I'm describing, maybe. Tredyffrin Township, Great Valley, Radnor. Great school districts are going to be high demand right now.
Yeah.
You know Radnor well?
I went to Radnor.
You went to Radnor?
Shout out Radnor.
Holy shit.
Yeah.
Is that Delco area or Delaware County?
Delaware County.
Yeah.
But it's like fake. It's fake Delco.
I've heard it. It's like Chester.
Depends who I'm talking to. I'm like, I'm from Delco. They're like, where'd you go to high school? I'm like, Radnor. Like,
where's your accent?
That ain't Delco, dude.
No, it's not. Where's your accent, bro? Come on, cuz.
Yeah, exactly.
Yeah, I think it's hyper local in Philadelphia, the main line, the Philaburbs, if you will.
Yeah.
And then in Philadelphia right now, like, personally, I've had 2 contracts right now that, you know, I priced one really well and I just price dropped one really well, and we're getting aggressive offers from buyers.
Yeah.
First time home buyers using FHA.
Yep.
One was an investor actually using a conventional 10% down. But yeah, those things are moving. I think that's the value that I have on the show, is like, I'm kind of actively doing this stuff, boots on the ground, where I'm seeing the agreements kind of come through.
Yeah. And
there's actually another story I want to touch on. I know I've been on a rant.
Yeah. No. Real quick. Just, I forget if we brought this up last time I was on, but like, you brought this up with like the price points, and like you can kind of almost control that, like push back. Like there's 3 variables in a real estate, more than 3, but 3 for like the price structure.
Yep.
So it's rates, construction cost, and purchase price. So right now, like rates are high. They are what they are. Construction costs are high. So make sure you're pushing on those sellers. Like that's the one variable right now that you can somewhat control. So you need to be pushing on the purchase price.
Yeah. And it's really important to have someone who's actively doing it, kind of representing you.
Yeah.
Even if you're a savvy investor, honestly, I mean, dude, without, especially on the sell side, right? So like whenever I'm looking at like, all right, who am I making this offer to?
Yeah.
If it's a broker that I'm very familiar with, or if it's an agent that I'm very familiar with, I feel like, all right, they're going to be very educational. Yeah. Once again, it's like always about educating the client. We say that all the time on the show.
Yeah.
The more information they have, the better decision they can make. So if I'm presenting a $20K less offer, which I am going to be this afternoon, Jim, look for my call, right? I need to educate him on what we're seeing right now. Look, at the end of the day, this is what's going on in the market. Yep. And that's why it's great having these kind of talks with you. You know, hopefully the viewers kind of can process this, and we're going to get this out as soon as possible, process this and deliver the value, right? What I'm telling my sellers is we're here. We could be here. I don't see us going here, right? Meaning up. It's either you want to hold this, rent it, and maybe wait another X amount of years. We don't know until the prices come back. But if you're not happy with this number right now, you know, these are your two options. You hold it, you rent it.
Yep.
We can keep it on the market for another 30 days, but I don't think days on market's going to help you look better.
Nope.
So anyway, it's these conversations where you need to be educating your client. And then on a buy side, you should be telling your client, like, dude, this is X days on market. They just did a $20K price drop. This is just the one scenario I'm talking about.
Yeah.
And let's make this offer with the $10K seller's assist. So you're coming to the table with little out of your pocket, which once again is being conservative in these down times, or this whatever you want to call it, uncertain times, right? And then you're also getting a house you're not renting next year.
Yeah.
So you're educating on both sides of the coin. And I'm always looking for the right representatives to like put those offers in with. I put offers into like people that work for like Tesla Realty Group or like, you know, Realty Mark, these 100% brokerages where people hang it,
right?
You know, and they have no education. They have no idea what's going on. So they can't educate their clients. So I'm always telling my buyer before we make this offer, hey, this agent might not be able to get us a good counter because they're not able to educate their client on what's the recent comps and all that.
So what do you do in that scenario?
For the agents, you mean?
Yeah.
Or the buyers and sellers?
No, like if you have someone who like an agent doesn't really know what they're doing and you have a client, like what do you do?
It's so unfortunate, but you just have to accept that, I think, and be like, they weren't able to educate their client and get us the deal that we wanted.
Wow.
And I always say this to my buyers and sellers, there's always something better around the corner. Like everything happens for a reason.
Yeah.
Maybe not in the short term, but in the long term, you're going to look back in 5-10 years, be like, I can't believe I was going to buy that house.
Very true. Yeah.
That area went to shit, or that block was bad. That neighbor was going to be terrible.
Yeah.
I'm, you know, a little bit more spiritual maybe than most agents. And I always try to bring that energy to like my buyers too. That's a good question.
Yeah.
And it's hard. It's hard because
it is
you're constantly
hard
trying to get deals done.
Yeah.
And you're not prioritizing the relationship or what it really is going to mean for them in the long term. But there's got to be a healthy balance of both if you're an agent.
Yeah.
Got to care about them.
Yeah.
So for the one story I was telling you about though with basically this guy's buying a storage warehouse, I2 industrial property.
Yeah.
He's manufacturing and storing goods. Like these are the kind of jobs that obviously we've always had. He's not a big Amazon or whatever, right? He's just a mom and pop starter. He fell into this. He created amazing plugins for electrical cars. And right now, what's a huge trend, you know, is electrical cars. Right.
That's right.
So his business is booming, right?
Not Teslas, though.
No.
People are out on Elon.
Yeah. Sorry, guys. But yeah, like he kind of fell into this, and we had a conversation yesterday. We're doing our due diligence. We have our inspector going through, our surveyor going through. Environmentals are going to happen if, you know, these two things kind of check out next week because you don't want to obviously do all three of them at once. If one of them falls through, it's like, why are we spending all this money on due diligence?
Yeah.
It's another conversation. But we're sitting there talking. He's like, man, I don't know what I'm going to do. Did you? You know, I'm like, yeah, I saw. You know, everyone saw what Trump just did the other day. And this was, when did the news break? Was it Monday or Friday?
No, it was before Friday. I think it was like Wednesday, Tuesday or Wednesday.
Tuesday, Wednesday of last week.
Rolled out the actual plan.
Yeah. So, I mean, it's been about a week to digest and like all the aftermath's happening. And this guy who's just a good dude, really growing his business, is even somewhat concerned. Like, what if I buy this for, you know, I won't say the price, X amount, and, you know, construction and all this manufacturing costs go up and I'm not calculating everything right.
Yeah.
It's so from first-time home buyers to investors to business owners, we're all feeling the same thing would be my point in that story. And all you can do as your agent if you rented a place, here's what it would look like. If you buy this place and you own it yourself and pay yourself the equity, here's what it would look like. What is the comfortable worst case scenario, and then just grow from that. And I think that'll be the theme of this.
Get comfortable with the worst case.
Andrew's kind of killing the show now. That's going to be the theme, I think, of 2025.
Yeah.
So that's really what I'm seeing.
Get comfortable with being uncomfortable.
Boom. Not easy, but possible with the right help.
It's possible.
Yeah.
It's possible.
Yeah.
Also, I'm going to butcher this quote. We might have to look it up. What's the Warren Buffett quote? Be fearful when greedy people are. No, wait, hold on. I'm going to butcher it. Let's just pull it up.
Yeah, Taylor.
We gotta get fearful when others are greedy, and greedy when others are fearful.
There you go. I don't know, man. There's a lot of fear out there right now.
A lot of fear.
There's a lot of fear.
I can smell it.
Dude,
walk out my door, I'm like,
oh, I love fear.
Yeah. It's the best. We go get some coffee and some breakfast. Yeah. I mean,
I don't know, man.
What are you doing right now? Are you in the stocks? Are you in the treasuries? Like our bonds, I should say.
Thank God I was not in the stocks. I know what I know well, and that's, real estate, lending.
Yeah.
If I invest in the stocks, it's like my buddy just being like, yo, man, you should go buy some of this. I'm like, okay, cool.
Yeah, sounds good.
I'll just follow you to the promised land.
What's the tagline?
Yeah.
You work with so many developers. Have you had any conversations recently with any of them about what's going on and maybe rehabbers, whatever it is?
Yeah, I mean, so the one, he's one of our clients. He's developing down the shore. He gave me the quote. I kind of just called him because he does a lot of volume down there, building,
nice.
1 to 4 unit stuff. So quadplexes, condos for sale, also spec single family, Margate, Ocean City. And I was expecting him to say, yeah, like things are going well, whatever. He told me, and this will probably resonate with you. He was like, I know the market's soft now because I'm getting the same buyers back for like a second, third, fourth tour. And he's like, they want to bring their mother-in-law, their brother, their cousin, their cousin's cousin. He's like, as soon as I start seeing that, I know it gets soft, because if they walked in and they liked it and they were serious, I'd have an offer. And he was like, last, end of the summer, kind of when the Fed was cutting rates, like he started to see a pickup. He was like, I don't know what happened, man. After the holidays started to slow down. This is just one guy's story, by the way, so take it with a grain of salt. But, I thought that was pretty telling, because that's like great feedback that I would never think. I'm a lender, and I'm not selling at that velocity. So like, that's a great indicator. Like people that are seriously buying, or they're like more walking through and they're like waiting for the right time, kind of. That's what it feels like.
For sure. I mean, that's great to hear.
Yeah.
Seeing it, like you said, it definitely does resonate.
Yeah,
yes.
And he was also the guy that told me the construction cost death by 1,000 cuts.
Yeah.
So he was like, it's not as much the framing and the concrete and all the big ticket line items on a budget. It's the little things. It's the, in addition to appliances, it's light fixtures, it's speakers, it's all that stuff, bells and whistles.
Yeah, I agree. And it's right now more important than ever to get your timelines rechecked with all your subs. Or all of your suppliers.
Yeah.
Check your timelines, because supply chain's obviously going to be affected by tariffs.
Yeah.
And also, obviously, check your costs. I mean, get an updated cost sheet every week if you can.
Yeah.
With this volatility in the market that we're seeing, things can change on a dime. And if you have a good rate, lock it in. Not on, percentage wise, but on, a good framing quote.
Right.
Lock in that quote.
Yeah. Couple things there. So like lending wise, if you're an investor developer, talk to your lender. Like at iFundCities right now, if you don't have a contingency in your budget, I'm like, yo, man, you're not going to pay interest on this unless you draw down on it, but I need you to put in a 10% contingency. Mm-hmm. Like if there's nothing in there, you could be the most experienced developer ever and shit happens. You know what I mean?
Contingency just meaning.
Thank you.
Yeah.
Contingency line item is usually, if you have a $400K budget, a 10% contingency would be $40,000, and that just sits at the bottom of your line item budget. Where if appliances came over or your framing lumber was higher, like you can draw down on that line item, pro rata completion of the project.
Okay.
Or you could just submit, hey, here's a receipt. I was $5,000 over this line item. I'm like, I don't want to fall behind on the project.
And you just draw from that.
You draw from this little contingency line item. or
some people might not have to touch it, right? I mean,
often, I mean, people that build the right budget or they have good GCs, they don't have to touch it, and you're not paying interest on it because you're not drawing down, right?
Exactly. That's something that I think we could definitely dive into on one of the shows. Maybe a little touch now, but how do draws work in terms of the interest? I'm learning a lot with my first project.
Yeah,
you could definitely talk on that.
100%. I just think it's so important to have that in there. I don't care if you've done one deal or 100 deals. Like, put in some contingency. You never know what's going to happen.
Yeah, and like right now, is there any for example, my brother was able to get the investor that we worked with to kind of put our framing in, foundation, footings, and all that stuff. Frame the house.
Yeah,
and then by the time we were connected with the bank to get the rest of the money, it was we kind of drew like $60K. We're only getting interest on that $60K. We're not getting interest on the rest of the project, right? And it's similar structure with what you work with.
Yeah, it's like called UPB, unpaid principal balance. So you could have, when you close a loan, let's say it's a $500,000 loan, and we give you $250 day one to go towards a purchase of a property. You'd have $250,000 in escrow. It's like construction holdback. So you're only paying interest on the $250 we gave you day one until you say, hey, Chris, the framing's done and the windows are in. I want to draw $80K. Then you draw $80K, right?
So now it's
$330.
Yeah.
Your UPB, unpaid principal balance, is $330, and now you're going to pay interest on that $330.
But that other $120,
you're not paying interest on until if you draw down on it.
Right.
We have a ton of investors that will do construction loans with us, and they self-fund it along the way, and then they'll either do a big draw at the end or they'll do 2 draws, so they're not paying interest. That's why having working capital is so important.
Yeah,
because it helps the actual margins of your deal.
Yeah, wow. I did not know that until this first project that I'm personally doing. So I could never advise my client, hey, what's your draw structure look like with your current lender?
Yeah,
I have another guy who could probably give you a better draw structure, right?
Right.
Is there an UPB?
UPB, unpaid principal balance.
Is there a UPB, kind of draw structure, or is it like you're getting interest on this entire loan the entire time? And maybe think about ordering these subs first, getting that draw, and then putting all these subs kind of in a similar time frame so you can bang this out quicker and not have interest tick.
Yeah.
Because 1 month on a bigger project could be a $10,000 interest, fee, basically.
Yeah. There's a lot of lenders out there too that'll charge interest on total loan, and maybe it's not disclosed. It's kind of like predatory lending, but it's interest on drawn dollars is the technical term, or total loan amount, just for the investors out there, or Dutch or non-Dutch interest.
I like that.
Yeah.
Where did that phrase come from?
I have no idea, but I like it too.
Just little details like that, make a huge, massive difference. Definitely 1,000 cuts. Save yourself with those kind of plays right there.
100%.
Yeah.
Yeah.
Overall, what are your last remarks on tariffs, where things are going to be heading in these next couple months? Let's just go with that first, and then long term.
Honestly, it feels like we're in just such a tug of war between Trump and the markets and China, where it's like, I don't know if you saw yesterday, there was some fake news article where it was oh, we're going to pause the tariffs for 90 days. Dude, the markets stopped, it went nuts, and it was just on fake news.
Yeah. No,
so that. What? Tell me.
That is the stuff that always trips me out, is how one piece of news equals crazy volatility.
Yeah.
Upwards or down.
Yeah. Yeah, the Dow went up. It was insane.
Where do you get your news from? Where's the most reliable place?
Squawk on the street. I don't know.
Yeah.
I just I always have it playing in the office, or I just start in the morning just listening to the podcast. They have it fresh every single day.
Yeah. Yeah. That's honestly our next level, is probably doing this every day if we could.
Yeah.
But for now, it's just once a week. But man, when you can have boots on the ground, it seems and just be constantly on this stuff.
Yeah.
Or at least know someone who's constantly listening to this stuff.
Yeah.
Yeah. It's just you can make much better decisions, which is ultimately what we're all here to do.
And it's honestly not even me. I get it from my partner, Brian, and Jack Davis, who run capital markets. I just make it sound pretty.
Yeah. Dude, you surrounded yourself with a fucking A-class, killer squad. You really have, all of them.
Yeah.
All of them. Complementary skill sets. You guys just work so fucking well together.
Yeah.
Man. It's really impressive.
Yeah. Appreciate it.
And just, once again, glad to have you and iFundCities kind of on the podcast now officially. If any of those guys want to hop on,
Yeah, I think it'd be awesome to have Ryan Herding,
Definitely.
founder, or Brian and Jack. Like, we do a webinar series every quarter.
Okay.
Or no, it's every month. To just kind of go over like capital markets from the institutional lending lens.
Mm-hmm.
So, would love to have any of them on, or viewers tune into that. It's pretty cool.
That'd be amazing. Any viewers that want to see that, just comment below, reach out to us. We'll definitely get that set up.
100%.
Yeah. And then, well, I guess we'll cut the episode, do an announcement after maybe.
Yeah, that works.
All right, cool.
Yeah.
Guys, thank you for tuning in to another episode of Broker's Blueprint. If you like what you're seeing, like, subscribe, comment down below on some things that you want to have on the show next, or topics you want to hear about next. Chris, welcome to the show.
Appreciate it, man.
Glad to have you.
Happy to be here.
Absolutely.
Thanks.
We'll see you guys next
See you guys.
time. Awesome.